Inventory is currently increasing, which is making the headlines and leading a lot of people to believe that the next step is home prices moving downward. So, Josh, let's spend a little bit of time today and talk about how all inventory isn't necessarily the same across the United States.
Absolutely. We've talked a million times here on the show, Jeb, that the media is not interested in educating you. That's what podcasts like this are for. They are interested in scaring you. The world is going to go up to 200 degrees. We're all going to die in 3 weeks, whatever the latest steady is that they have. So we're going to talk a little about the data. There is data that there are pockets of the country that have got back to where we were in 2019. They haven't got above 2019 inventory levels, but they've got back there. And let's kind of just take a step back and start with, why do we care? Why do we care? We talk about all the time that home prices are a function of supply and demand. And most importantly, the balance between supply and demand. So you can have low demand, but if there's low supply, prices, as we've seen over the last couple of years, are going to continue to go up. You could have high supply, but if you have a really high demand, they can go up, they can stay level. So obviously the fear here, the fear that's being traded on in the media is inventory is spiking. So what are we actually seeing in the data, Jeb?
Well, we're going to talk about that, but I think it's important to kind of talk about supply just for a moment, because there's always been this adage out there, if you will, that's, once supply gets to 6 months in a market, just kind of as a general statement, you reach 6 months supply, then it's automatically a buyer's market, or it's automatically this market if it's below this number or what have you. And while there has been some truth to that, I think what people need to understand is that not all inventory is created equal. And looking just at inventory at the moment, numbers doesn't necessarily tell the whole story. And I think that's where the conversation should really go. It's what's happening in some markets out there is something that I don't know if alarming is the right word, but it's something you absolutely should be paying attention to if you're in one of those markets. Whereas if you're not in one of those markets, it's probably less of a concern. So let's, when I say that, Josh, I guess what comes to mind?
Something that was unsaid in what you just said is that inventory at different price tiers can be behaving differently.
Absolutely.
And what we are seeing for us in most of the markets that we're in, we have a very limited supply of available homes for first-time buyers. So even if inventory as a whole is going up, that's generally being led by homes in the higher price points taking longer. So if you want a $3 million home, you probably have plenty of inventory to select from. If you want a $300,000 home, depending on where you are in the country, that's going to be impossible or very near impossible to find, or you're going to find that there's 3, 5, 7 other families also wanting to bid on that. And, a conversation for another show that we could go on for a whole hour. John Wake is an analyst out of Arizona, and I'm on a series of emails that he puts out. And one of them, he just made a real simple point in one paragraph. Supply of housing is incredibly inelastic. And what does that mean? It means that if tomorrow there's a massive demand for new Air Jordans, whatever, Hoka's, the big fat squishy shoes, something comes out, they can pump out as many of those as is needed to satisfy the market. Housing is not that way. There's a long lead time. There's big costs. There's massive regulation. Yep. So nothing is coming to the rescue. The threat, the hope, the dream of people who need prices to be lower to be able to buy in their current market with their current financial situation is that there's going to be a crash. We've talked about this repeatedly on the show. That only happens with a massive increase in supply and a specific type of supply, distressed supply. Homes that are bank owned. Bank is not in the business of owning a home. They will liquidate it at whatever cost. Again, probably a topic for another show, but that's where supply comes in. What we really, though, want to talk about today is supply months of inventory, what it looks like in different parts of the country, and how that should be impacting your thought and decision making as a first-time homebuyer or a potential first-time homebuyer.
And with that, let's look at some stats. But before we do that, I'd like to take a minute and ask a favor. If you find any value in the show at all, do us a favor, hit the thumbs up. If you support the work we do here, want to stay updated on everything that's happening in the market, do us a favor and also consider subscribing to the channel. So Josh, I think, I started saying inventory's up. It leads the headline. So one of the headlines out there is that nearly 90% of U.S. metropolitan areas now have more homes for sale than at the same point last year. Okay, that sounds really crazy, right? 90% of the markets have more inventory than last year until we go back and we look at inventory last year. It's everything's relative, right? You can say foreclosures are up 100%, but if there was only one foreclosure last year and now there's two, doesn't really mean a lot, right? So you got to understand the context of it. So when we say 90% are up, also with that, inventory in 14 of the top 100 markets have returned to pre-pandemic levels. So that 2017 to 2019. So 14 out of 100. So that means 86, Josh, 86, if we reframe it the other way, have not returned to pre-pandemic levels.
Let me make an additional point on that before you go further with those statistics. 2017 to 2019 wasn't some golden era where there was a massive amount of supply and buyers could just go in and name their price. It was a seller's market, but it was closer to balanced, where the really nice houses, you were having 2-3 offers on them and you might have to outbid someone. An average house, if it was a good location and you were willing to put in some elbow grease, you could get a good price. So we're not talking about getting back to some golden era level of supply. It's just something that was close. It's our most recent memory of something that was close to a balanced market.
Yeah. And with that, I think it's important to note, we're not pointing this out as like a dagger, putting it in there and like inventory is never going to return, or that, hey, yeah, market's improving, but it's still not back here. Therefore it's still a competitive market. I think what's important to note is that it's all relative, guys. Real estate is local. That's kind of the premise behind today's episode, is that depending on where you're located in the country, you're seeing a different story. And a lot of people watch my channel, they follow the podcast, and they think, oh, well, that's not what I'm seeing in my market, therefore you're wrong. No, we can both be right. We can both have something different happening in the market, and it might affect your decision a little bit differently. So with that, Josh, let's talk about what's happening here in Orange County, as something you mentioned a moment ago. So in Orange County, again, why do you care about Orange County? You probably don't, right? Unless you're in Orange County. And we'll talk about that here in a minute, but that's our market. So I want to give you some stats, like some context when we talk about the market. So at the moment, Orange County, 49% of the inventory is below $1.5 million. So 51% is still above $1.5 million. And that's crazy for a lot of markets out there. But here's the crazier part. Of that 49% inventory, 72% of the buyer demand is looking at that inventory. So you got more demand than you have supply. So demand is muted, right? So demand is down. Inventory is also down, which creates a more balanced market. But it still favors sellers because you have nearly a third more demand than you have inventory looking to purchase those homes. But it flips a little bit, Josh. You mentioned $3 million homes a minute ago. In Orange County,
low. I was too low.
18% of our inventory is above $4 million. 18%. And that's like 2,700 homes. So if you go 18%, what's that? 540? Let's just say 500 of the 2,700 homes are above $4 million. The problem there is only 3% of the buyer demand. So you got a lot less demand looking at a lot more inventory. So guess what happens there? Buyers have more choices. It's more of a buyer's market in that regard, right? So they can not necessarily come in and just name a price, but the seller knows I've got competition. I've got to be competitive if they're trying to get rid of those homes. Now, we're going to take a look at Florida and some other markets here, Josh, but when you hear that, is that a similar story you're hearing when talking to buyers across the country when you're, talking pre-approvals and that sort of thing?
100%. Here's the thing that sucks. My bread and butter, people think, oh, you're in Orange County, you're dealing with all these multi-million-dollar buyers. I am not. There are many loan officers that are. We've talked about our buddy down the way here. Almost all of his clients are buying $2 million homes. The broker of record at United American Mortgage, I think his average loan amount is in the low $2 million. So even with little ones, he's doing $3, $4, and $5 million ones. So we are in a market that has a lot of that. My bread and butter is that entry-level buyer. And for us locally, that entry-level buyer is now $700,000, $800,000, $900,000. And that sounds insane because it is insane. But I also deal with buyers around the country. So we have people buying $280,000 homes in Texas, $225,000 homes in Florida. So I'm seeing this same thing in that the higher you go in those price tiers in your market, like $4 million, if you're, in the middle of Indiana, $4 million, there might be 5 total houses at that price. I could be wrong. There could be 20 of them. So that price point is going to, your price there are, just so you know, there are very expensive homes everywhere.
Side note, while you're talking about Indiana, a buddy of mine posted a house today, and it had a pool in the backyard. It had a half basketball court in the backyard. And in the next Instagram, like the next post, it was on Instagram, he posted a house that was $345,000. I was thinking, there's no way that house was $345,000. So I messaged him. I'm like, was that the house for $345,000? He's like, yeah, welcome to Indiana. I'm like, Jesus. Yeah. Like that's what I want here.
And Jeb, a flashback. We did an episode on relocating to a lower cost of living area. And there's some very interesting numbers in there. People think, well, yeah, great. I make $150,000 in Southern California. If I go to Indiana, I'm going to make $40,000. Not true. It is not proportional. The housing is much more affordable in those markets. But what I was saying is wherever that tier is in your area, maybe the expensive market in Indiana is $1 million. $1 million buyer is like, hey, this isn't too bad. I don't like my payment because the interest rate's high, but I go out and see several nice homes, kind of pick who's going to negotiate with me. The people that are buying the $250,000 home in that market are not having that time. So for me, my bread and butter, again, being more of the entry level, I get excited when someone comes to me and wants an expensive home, not because it's a big loan, but because, hey, this person's going to be able to go out and find something that they're happy with. If they're a motivated, qualified buyer, they are able demand, they're going to go find the supply that they need. It is not the case in nearly every market that we operate in. And that includes Texas. I remember my Texas buyers are having much less of a difficult time. It is one of the markets, and I think you have the data here, it is one of the markets that is back very, very close to pre-pandemic levels. And by all means, those folks are having an easier time. They're not having to write 20 offers. They're not having to compete against 10 offers on a home, but they're not walking in and naming their price in most situations either.
Well, let's talk about that. Let's talk about real estate being local, because this is some interesting data that was pulled from Calculated Risk. But a moment ago, we mentioned 14% of the top 100 markets have returned to pre-pandemic levels. So of those markets, Florida, Texas, Colorado accounts for most of that increase in inventory that we're seeing out there. So, but to follow that, every major market, Florida market, has had at least 50% more inventory in April than at the same time last year. Cape Coral up 87% over the past 12 months. Lakeland, Florida has the largest surplus with 43% more homes for sale in April than it averaged from 2017 to 2019. So it's above those levels, Josh, 43% more. That's a big deal. Austin, Texas, next at 29%. San Antonio coming in at 27%. And then flip side. So real estate being local. We've just talked about Florida there. Talked about Texas. Now let's talk about Connecticut. In Hartford, Bridgeport, New Haven have the deepest inventory deficits, down 75%, with little movement from the same time last year as inventory levels remain a huge challenge. So that, right? So two different, all East Coast for the most part, outside of Texas there. But big differences in those markets. And, when we say real estate is local, that's what you need to pay attention to. But more importantly, Josh, we are going to talk about the things that you need to pay attention to. But let's talk about what's causing it. What would create more of a balance, I think, is what most people probably want to know, more so than, hey, this, I'm in Florida. Yeah, there's a lot more property, or I'm in Connecticut. There's none. Like what's the big driver here?
If we talk nationwide, we just went through this. The levels are different. The levels are different depending on where you are. But the cause of inventory being up year over year is not a lack of demand, meaning intrinsic demand. People who have reached a stage in life where they want to buy a house. It's the lack of able demand, where they do not feel that they are either able to qualify or comfortable signing on for the payment that would be required if they were to take on that mortgage. So truly, interest rates. We've done a show on homeowners insurance in several parts of the country. Homeowners insurance is considerably more expensive than what it was. So all of those things contribute to affordability. We had the jobs report come out today. It shows that wage growth was at 4.1% year over year, which the 20-year average is like 2.5%. So wage growth is good right now. But in terms of affordability, home prices haven't come down. So we had a 40% plus run up in most markets around the country. We had a tripling of interest rates, literally tripling. I spoke to a borrower this morning that's looking for a second mortgage because we got them in at 2.625 with 0 points. I couldn't believe it. I looked at the closing disclosure and I'm like, 2.625 with 0 points. So he had to have actually got in at the absolute very best point. But for that, if he wants to sell his house, he paid $450,000. That house is now $725,000. And the interest rate is not 2.625, it's 7.25. That is making homes, everything is less affordable than it was 5 years ago. Nothing is even in the same realm as the lack of affordability of homes. People, again, that intrinsic demand, people wanting to own a home, to have a home base, a nest, a roof over their head, somewhere to raise their kids, schools, all that stuff, to build memories, that's never going away. But most people also have the logical side of their brain going, yeah, but it's got to make sense. So demand down, either through just unwillingness or inability to qualify.
Well, then on top of that, let's talk something about Florida, right? Florida, the Gulf Coast has some things that we don't have here in California. Well, I guess we have it, but not in the same degree, right? Insurance issues. So insurance is a big problem in some of these states that are hurricane prone, that are natural disaster prone. When I say California, yes, we have it, but it's definitely more prevalent down in Florida, Louisiana, parts of Texas, that on that Gulf Coast. But on top of that, you've got the condo issue that's happening down in South Florida, where the state of Florida has basically come in and said any condo over 30 years old has to have a full audit done, not on the financials so much of the community, but the structure itself, and it needs to be brought up to 2024 standards. It needs to be brought up to code. And what's happened with these audits is there was an example in the Wall Street Journal where it was like a $30 million renovation that was going to happen in order to bring the building up to code. And guess what? Prior to this, the state of Florida didn't have a certain reserve requirement for HOA. So these HOAs could basically operate at more or less zero reserves for things that needed to be done in the community. And so they're assessing each homeowner in this particular building. It was like they were assessing them each $150,000.
And I've seen several stories, Jeff. Yeah. That's not like one crazy case. Several stories where that was the case of 100,000 plus assessment per unit in a building.
Yeah, and so guess what happens in those situations? If you're not sitting on $100,000, you got to sell. You got to get out of there, because otherwise the HOA can foreclose. There's other things that can happen that makes you have to liquidate that asset. So guess what? Insurance costs are going up. Building like assessment, HOA issues are going up. Higher rates. So you've got kind of a tripling of different things that could affect the market in those areas. And now you've got these problems. Now, does that transfer its way into Oklahoma? Probably not. So that's where things vary a little bit. And even then, Josh, you said when we look at Florida, I know Jacksonville inventory is up, but the majority of the concentration of these issues is Southwest Florida for the most part. I think that's where the majority of inventory is growing. It's not the entire state. Not every single county is doing that. So you can be in Florida and your market can vary, from the county next door, just because of how things are, being a little bit further away from the coast, being a little bit less prone to natural disasters, not having the HOA issues, all of that stuff.
Yeah, all of that. So what we just talked about there is some specific issues that are only applicable to Florida. I think in terms of prior to 2008, The media loved to say, hey, there has never been a nationwide downturn in home prices. And that was true. There was never a dip in the entire broad homogenous market across the United States on a year over year basis. But we had absolutely seen dips regionally, locally, especially for us in California. California was always a cyclical market. There were a handful of them. Florida has always been one. But the big one that comes to my mind, in the early 80s, the Houston real estate market got decimated. And you're like, well, there was high inflation and interest rates shot up. It was because of all of the things that was going on with oil in the Middle East. The oil, it was a huge part of their economy. That segment of the economy just got obliterated. And so you had all sorts of distressed, forced sales that brought prices way down real quick. Because if you didn't want to sell, you had to sell, no choice but to sell, or the bank took your house back and they don't want to own it. They have no choice but to sell. That's what causes these liquidation prices. So I don't know that we're going to have an area as dependent on a single type of economy as industry as Houston was on oil, but a little bit, Jeb, you had a conversation this week, San Francisco. Why did we see big dips in a brief period of time? There were political issues, but also economic issues that they are heavily tied to one industry that in a moment of time, that industry said, hey, we don't really need to be in this area. We can go and find places where we can be cheaper, where we can get taxed less, and our employees can have cheaper housing. So that's another big piece of it, that no matter where you are, you want to look at your local economy. How diversified is it and how strong is it?
Agreed. So let's take a minute here and just talk about what does this mean for prices, right? So prices nationwide, based on Fannie Mae's home price index, up 6.5% year over year. Depending on what index you're looking at, it ranges between 5 and about 6.5%. Does it matter, Josh? I mean, I don't like the year over year calculations because I feel like it's weird because of how it's calculated. Just like inflation, just like anything else, it doesn't tell you so much as to what's happening right this second. It just says, hey, based on past data, this is essentially what happened. Nobody cares about what happened a year ago. People want to know what happens going forward.
Well, Jeb, I don't know if this bugs you, but it bugs the heck out of me every year when we get in the first part of spring and the month over month figures start going up. And you're like, yeah, no kidding. We're getting into the part of the year where most of the appreciation occurs. And then we get towards the first part of the summer and it's still going up because you're in the part of the year where we get appreciation, but it's going up at a lower pace. And again, the media, our friends in the media love to say, ooh, home price appreciation is slowing. You're like, dude, that is seasonal. Even if we were in a downtrending market, it would dip less in the spring, slightly more in the midsummer, and more still in the fall and winter. So there's a seasonality to it that we should all know and expect. And when I look at this, Jeb, the most important thing that I say, we've been doing this show for almost 3 years, right at the very beginning of sort of the turn. And we looked at it and said, okay, if interest rates are going that high, we are going to see a dip in prices. And you watch it play out, and in many areas you did, and then it fairly rapidly stabilized once people got used to it. So long way of saying, we have both been surprised by the strength of the market. I would have never guessed that the last 2 years would have been above 5% appreciation. We've said a million times on the show, long-term appreciation, 30, 40 years in the United States is under 5%. It's 4 and change.
4.65, I think I saw.
So when you're seeing 2 years of above trend growth coming off 3 or 4 years of massively above trend growth, it tells you something about it. It's not the strength of the housing market. It's not like everyone goes, oh my God, this is the greatest time I got to jump in and buy. It tells you about that supply demand imbalance. There's not enough of the asset and there is still a great demand for it and enough people who can and will qualify for those loans to bite and step into that. So where I'm going with it, I said our best case, people love to think that they want to see a 25% dip in prices because then they're going to buy. I've seen it. I've seen it happen and no one buys. They get scared. They get petrified. It's going to go lower. I'm going to wait for it to go to 35%. Or, hey, it's never going to be a good investment. I'm not going to buy. People didn't really start buying in earnest until 2015, almost a decade after 2008. So you think you want that, but I can tell you for a fact you do not. So the best thing we could have for the market would be 5 to 7 years of 0 to 1% appreciation. No dips, so people aren't panicking. No appreciation, so those 3-4% wage increases, normalization of interest rates, you get back to an affordability level that is lower than where we were in 2000, in 2010, but still closer to the norm where you have more demand to absorb that supply. The supply issue is not going away because we are not going to hit a point where you have a massive amount of distressed sales bringing this volume of homes to the market because of the strength of the home buyer. Not everyone's a strong home buyer. Most people bought early and financed at a very affordable rate.
No, I agree with all that. And with that, I do believe you'll see that. I do believe you'll see some normalization of the housing market. I think it comes with time. It's just, it's hard to see it at the moment just because of everything going on. It's really difficult to see the light at the end of the tunnel because we're all going through it in some way. Those that own a house, if they're staying in their house forever, then maybe not. But most people have bought a house. It's not their forever home. They're still feeling a little bit of that. Hey, this is not, I don't want to be locked into this property forever, or those getting in, I'll never be able to afford. We see it all the time, Josh. It's, yes, things normalize. It will just, so in the meantime, Josh, what should home buyers, our educated home buyers rather, be focusing on in the current environment when we're saying, supply matters, but it's relative. Demand matters, but it's relative. You get maybe a little bit of mixed messages to some degree. So what should somebody be paying attention to?
Macro, midterm, 2, 3, 5 years. Everyone thinks the recession is off the table. I have some really smart people that don't necessarily think that. But what you need to be looking at is locally your economy. Is it a strong, diversified economy? For us, like here in Southern California, UCLA does a California economic study, and I think they release it quarterly, if not annually. Chapman University does an Orange County study. So I guarantee you there's a university in your area that they're...
Well, let me stop you there. Theirs said that home prices were going to drop like 10% last year, by the way. So
I don't care what they say about home prices because they don't understand. They just look at historic price points and go, hey, we're too far above where we were. It has to have this massive correction. Do not care about what they say about home prices. What do they say about the economy, the economic base? Because that is what makes sure that you're not having any level of distress, that you're going to have an amount of demand, that there are people, it may not be you, but there are people with good jobs who can afford to buy homes.
It's not me, Josh. It's definitely not me. My job's not good. Kidding. I'm very appreciative of what I get to do. No, so when you say local data, Josh, or macro, yeah, find somebody that you trust locally, follow the data, follow the information. Again, the headlines can lead you down the wrong path. So if you do look at the headlines, make sure you read deeper, understand the context of it. Like Josh was talking earlier about the San Francisco deal. I sent him an article. It was from Newsweek. And basically the premise of the article was that how home prices had declined so much and they were falling or crashing in San Francisco. And then in the very last paragraph, maybe the last 2 sentences, they go on to say, this is kind of isolated based on politics and everything that happened in San Francisco. Like, okay, you probably should have started the article with that because that's what's important to the reader. But the reader doesn't make it that far down. So find somebody that you trust, because even within a market, even within Orange County, you can have pockets of the market that are still strong, while other pockets might be seeing a little bit larger increase in inventory, right? It all varies, by zip code, by neighborhood, that sort of thing. So pay attention to that stuff.
Jeb, to just underline what you just said, we try to bring on guests that have that focus, that have that data. And the one person that I know, we're not plugging him. We don't have any affiliate relationship. We don't get paid. Lance Lambert over at Resi Club, he's taking other people's data, aggregating it, compiling it, and you can go down to the zip code level to see what is happening in the zip code that I want to live in. If you're in California and now Arizona and Nevada, Stephen Thomas covers data. Mike Simonson at Altos Research. There are people that are gathering the data for everywhere in the United States. If you are serious about buying and you are not sure what to do, please do not pick up the newspaper, even if it's the Wall Street Journal, where you think, it's a business paper, it's not partisan, whatever. Find someone who is knee-deep in the industry and analyzing that data and figure out what you're comfortable paying. No one is as cheap and has as good a data and is as dispassionate and removed and sort of even-handed as Lance over at Resi Club. So if you're in the market and you're not sure, I would get the subscription for the next 2, 3, 4, 5, 6 months and watch when they pump out that data every month. They take that map down to the state level, county level, zip level, and see what's happening.
No, that's good stuff. So, again, going back to it, inventory doesn't necessarily tell the whole story. So just make sure you're paying attention to these other things in the market that might affect you. But more importantly than anything else, if you consider buying, have a longer term time horizon, have money in the bank, be comfortable with the payment, buy for the next 5, 7, 10 years of what you think you'll need in a home, and don't focus on the here and now. Look a little bit longer term. It can be difficult, but it is the important thing to do. Until next time.
Josh, hold on. I got one more thing. Then you can go your third shot at it. We talk here on the show, Jeb, about working with pros. Well, how do you know a pro? Well, you get a referral. You look at their reviews.
Yep.
You know it when you see it. What I will say is I talk to a lot of buyers, and they've talked to other lenders. They've talked to realtors. And I will tell you, I hear the most horseshit stories. They'll tell me, well, my realtor said this is going to happen because of this. You're like, that's his opinion. There's literally no data there. So anyone that you're working with, hopefully they have data. They have the Resi Club data. They know how to go. You guys get really good reports out of the MLS, Jeb. They should be able to pull the data and show you, okay, I understand that you are saying nationwide that they're up 35%. Well, here's the good news. In our market, we're only up 22%, and we're still 35% below 2019. So as a buyer, you have some cushion and some buffer. They shouldn't be telling you their opinion, whether they're a lender or a realtor. They should be saying, here's what I believe based off of this data. These are both numeric database businesses. Even though real estate is more emotional because you're looking at the pretty house where you're going to raise your family, they're still numbers. Make sure you're working with someone that can give you the facts behind their opinions on the market.
And with that, Josh, plug the link below. If you want to get in touch with Josh, get in touch with myself. We can refer you to somebody in whatever market you're looking if we don't cover it personally. Find an agent, find a real estate broker, mortgage professional that aggregates their own data, like us. Josh and I started putting our data together going back almost 2 years now because we wanted to keep track of the local market. So if we can be of service to you, we would love that opportunity. Here we're going to go, Josh. Or here we're going to go? Like, who's even talking over here? Jesus, I think it's time to end this. Buy right, borrow smart, build wealth. Adios.
Amigos.